Think your 9 to 5 is your only shot at success? Think again. Welcome to Next Gen Rich 30, the home of side hustles, smart money moves, and straight-up wealth-building wisdom. Here, we don't just talk about money. We teach you how to multiply it. Want to launch a profitable side hustle without quitting your day job? Curious how to budget like a pro and still enjoy life? Wondering how to build real wealth in your 20s and 30s, even if you're starting from zero? Every week, we break down high-impact money tips, step-by-step income hacks, and battle-tested strategies to help you grow your net worth faster than ever. No fluff, no financial jargon, just actionable insights for real results. From budgeting on a tight income to investing smartly and creating multiple income streams, we've got you covered. So if you're ready to ditch the broke mindset, stop living paycheck to paycheck, and start building your money empire, hit that subscribe button. This is your financial glow-up zone. Let's level up. Have you ever wondered why? No matter how much you save or how often you try to invest, you're still not getting ahead financially? Maybe you've dabbled in stocks, crypto, or mutual funds, but your portfolio feels more like a roller coaster than a path to wealth. The truth is, most people who try to invest don't fail because they picked the wrong stock. They fail because they made one or more of the 10 worst investing mistakes that quietly drain your wealth. These aren't flashy, dramatic errors. They're subtle, sneaky, and incredibly common. And they're keeping people broke without even realizing it. In this video, we're going to break down the most dangerous investing traps. The ones that kill your returns, erode your confidence, and make the idea of financial freedom feel more like a fantasy than a goal. We're not just listing random tips. We're talking about real, experience-based mistakes that millions of people make every day, mistakes that have cost people their retirement savings, their emergency funds, and even their sense of financial security. And most importantly, you'll learn exactly how to avoid them. You might be thinking, I already kind of know what not to do. But trust me, some of these are things even seasoned investors overlook. Are you chasing quick wins because social media made a stock look hot? Do you feel overwhelmed and throw your money into something without really knowing what it is? Are you waiting for the perfect time to invest and accidentally missing years of potential growth? These are just a few of the dangerous habits we're exposing today. And if you recognize even one of them in your investing journey, that's not a reason to panic. It's a reason to pay close attention. By the end of this video, you'll not only understand the mistakes that could be sabotaging your financial growth, you'll have a clear roadmap to avoid them, stay disciplined, and start building real, sustainable wealth. Whether you're a beginner to try to make your first investment, or you've been in the game for a while, but can't seem to get results, this video will give you the insight you need to level up. Let's dive in and make sure your money is working for you, not against you. Mistake number 1. And arguably one of the most tempting traps for new investors is chasing quick gains. You've probably seen it before. A stock skyrockets 300% overnight. A cryptocurrency makes headlines, or a friend brags about doubling their money in a week. Suddenly, you feel like you're missing out. So you jump in, maybe without research, without a strategy, just pure FOMO. And more often than not, by the time you invest, the hype is peaking and the price is already on its way down. You didn't invest, you speculated. And speculation without a solid foundation is just gambling in disguise. Chasing quick gains isn't just risky, it's psychologically damaging. It conditions you to expect fast results and instant gratification, which is the opposite of what real investing is about. It turns every red candle into a panic signal and every green candle into a trigger to buy more, regardless of fundamentals. It makes you reactive instead of strategic. And the worst part? Even if you win once, you're likely to lose the next 5 times because the market doesn't reward randomness. It rewards discipline, patience, and informed decisions. This mistake is especially common in the age of social media. Platforms like TikTok, Reddit, and Twitter are filled with people flaunting their overnight wins. But what you don't see are the silent losses, the blown-up accounts, and the people too embarrassed to admit they got burned. The truth is, fast money often leads to fast regret, and the next big thing is usually only big in hindsight. Instead of chasing what's hot, focus on what's smart. Look for investments that make sense over the long haul. Companies with solid financials, industries with real growth potential, and assets that align with your goals. Understand what you're buying. Have an entry and exit plan. Know your risk tolerance. And remember that wealth isn't built in one big trade. It's built through consistent, intelligent decisions over time. If you're always trying to get rich quick, you'll likely end up getting poor faster. But if you shift your mindset to long-term wealth building, the wins may not be flashy, but they'll be real, lasting, and life-changing. Don't chase the shortcut. Build the foundation. That's how real investors win. Mistake number 2 is one that trips up beginners and seasoned investors alike. Not knowing what you're actually investing in. It's one of the quietest wealth killers out there because it disguises itself as confidence. You hear a tip from a coworker, see a flashy video on YouTube, or read a viral Reddit post, and boom, you throw your money into a stock, ETF, or crypto project that you barely understand. Maybe you know the name, maybe the logo looks cool, but beyond that, nothing. No idea what the company does, who runs it, how it makes money, or even what factors affect its price. And just like that, you've invested blindly. Investing without understanding is like signing a contract without reading the fine print. It might work out sometimes, but more often than not, you'll miss the warning signs like red flags in financial reports, unsustainable growth, or shady leadership. And when things go south, you won't know why it happened, or worse, what to do next. Should you hold? Sell? Buy more? Without clarity, every dip feels like a crisis, and every headline sends you into panic mode. This mistake isn't just about individual stocks. It happens with index funds, real estate, crypto, and even NFTs. People buy into things because they heard it was a smart move, not because they understand how it fits into their financial plan. But real investing isn't about copying what others do. It's about making informed decisions based on your own goals, risk tolerance, and timeline. If you don't know what something is or how it works, stop. Learn first, then invest. You wouldn't get surgery from someone who heard it was easy. Don't treat your money any differently. The good news? This mistake is 100% avoidable. It just takes a little curiosity and a willingness to dig deeper. Read company reports, watch interviews with the leadership team, understand the business model, and know how that investment could grow or fall. Knowledge gives you control. It gives you confidence. And most importantly, it keeps you from being the person who buys high out of hype and sells low out of fear. In the end, the more you understand what you own, the better decisions you'll make, and the more secure your financial future becomes. Mistake number 3 is one of the most widespread delusions in investing: trying to time the market. Everyone wants to believe they can predict the perfect moment to buy at the bottom and sell at the top. It feels smart. It feels strategic. But in reality, it's almost always a losing game. Even professional investors with teams of analysts and mountains of data get it wrong more often than they get it right. So what makes us think we can consistently outguess a market driven by trillions of variables, global events, and unpredictable human behavior? Timing the market is driven by 2 powerful emotions: fear and greed. When markets crash, fear kicks in and people rush to sell, locking in losses just before things rebound. When markets soar, greed takes over and people pile in, often right before a correction. It's a cycle of reaction, not strategy. And the worst part? Even if you happen to get lucky once, it reinforces the belief that you can do it again. That's where the real damage starts, because luck isn't a repeatable investment strategy. The cost of missing the market's best days is staggering. History shows that just being out of the market for a few of the best performing days each year can cut your long-term returns in half. And you know what's crazy? Those best days often come right after the worst ones, which means if you panic and sell during a dip, you're likely to miss the rebound entirely. Timing the market doesn't just require knowing when to get out. It also demands knowing exactly when to get back in. That's nearly impossible, and trying to do it consistently? Financial suicide. The alternative? Time in the market. Instead of trying to jump in and out based on headlines or gut feelings, build a strategy that lets you stay invested through ups and downs. Dollar cost averaging, where you invest a set amount regularly, is a proven method to smooth out volatility and avoid emotional decisions. And when you stay in the game, you benefit from compounding, dividends, and long-term growth trends that short-term traders often miss entirely. So stop chasing the fantasy of perfect timing. The real wealth is made by those who stay consistent, stay invested, and trust the process, not the guesswork. Mistake number 4 costs people more money than any bad stock pick or market crash ever could. Not starting early. It's deceptively simple, but delaying your investing journey, even by just a few years, can drastically reduce the amount of wealth you're able to build over your lifetime. And yet, this is one of the most common mistakes people make. They wait. They tell themselves they'll invest once I make more money, or once I understand everything, or next year for sure. But the truth is, the longer you wait, the harder it becomes to catch up, and the more you miss out on the most powerful force in investing: compound interest. Compound interest is often called the 8th wonder of the world for a reason. It doesn't just grow your money. It grows your money's ability to grow more money. It's exponential. Let's put it in perspective. If you start investing $200 a month at age 25 and earn an average annual return of 8%, by the time you're 65, you'll have over $600,000. But if you wait just 10 years and start at age 35, that number drops to around $270,000. Less than half, even though you invested the same amount. That's the silent penalty of procrastination. The mistake of starting late doesn't just hurt your net worth. It affects your mindset. When you start early, you get to grow with the market. You get to learn, adjust, and recover from mistakes without panic. You experience the ups and downs and develop emotional resilience. But when you start late, the pressure is higher, the fear is stronger, and the margin for error is much smaller. That leads to rushed decisions, higher risks, and often disappointment. The good news? Starting early isn't about having a lot of money. It's about consistency. Even small contributions can turn into something massive over time. The earlier you start, the more you can lean on time instead of hustle. You don't have to be perfect. You just have to begin. So if you're thinking, it's too early for me, or I don't have enough to invest yet, flip that mindset. Time is your greatest asset. And every day you delay is money left on the table. Don't wait for the perfect moment. Start now, learn as you go, and let time do the heavy lifting. Mistake number 5 is a classic, and it's as dangerous today as it was 100 years ago: putting all your eggs in one basket. It's the financial equivalent of walking a tightrope without a safety net. When you concentrate all your investments into a single stock, sector, or asset class, you're essentially betting everything on one outcome going right. And if it doesn't, the consequences can be devastating. The appeal of going all in is easy to understand. Maybe you believe in a company's mission. Maybe a certain cryptocurrency skyrocketed and made headlines, and you feel like you missed out. So this time, you're ready to go big. Or maybe someone you trust told you, this one's a sure thing. But in investing, there are no guarantees. Companies fail, markets shift, industries get disrupted, and when your entire portfolio is tied to one idea, one stock, or one trend, a single piece of bad news can erase months or years of progress in a single day. Diversification is how you protect yourself from that risk. It doesn't mean spreading your money randomly. It means intentionally investing across different assets, industries, and even geographic regions, so that when one part of your portfolio dips, another might rise or stay stable. It smooths out volatility and gives your investments more resilience. You're not just betting on one outcome. You're building a system that can survive many outcomes. People often resist diversification because it seems like it slows down growth. If I just put everything into this one stock, I'll make so much more. And maybe in the short term, that's true. But long-term investing isn't a sprint. It's a marathon, and your number one job in a marathon is to stay in the race. Diversification helps you do that. It gives you peace of mind. It allows you to sleep at night knowing that one bad headline won't wipe out your future. Think of your portfolio like a well-balanced plate. You would need only one food every day and expect to be healthy. The same logic applies to your investments. Build a mix. Spread your risk. Don't put your future in the hands of a single bet, no matter how promising it looks. Protect your downside so you can stay in the game long enough to win. Mistake number 6 is one that quietly eats away at your wealth without making any noise: ignoring fees and taxes. It's easy to overlook because they don't always show up in bright red on your investment dashboard. They're subtle, they're small, sometimes just fractions of a percent, but over time, they can cost you tens of thousands of dollars, maybe even more. And the worst part? Most investors don't even realize it's happening until it's too late. Let's talk about fees first. Many mutual funds, for example, come with something called an expense ratio, a percentage taken out of your investment every single year just from managing the fund. It might seem harmless. What's 1%, right? But over a few decades, that 1% can reduce your total returns by 25% or more. And that's before you even count trading fees, commissions, and advisor costs. Actively managed funds tend to have the highest fees, yet they often underperform simple index funds that cost a fraction as much. The math is clear. Lower fees equals more money in your pocket. Then there are taxes, the silent killer of investment gains. If you're constantly buying and selling, especially in a regular brokerage account, you could be racking up serious tax liabilities. Every time you sell an investment at a profit, you may owe capital gains tax. Short-term if you held it for less than a year, and long-term if you held it longer. Short-term capital gains are taxed at your regular income rate, which can be significantly higher than long-term rates. So if you're flipping investments or trying to time a market, you might be handing a big chunk of your profit straight to the government. The solution? Be intentional. Choose low-cost index funds or ETFs with minimal expense ratios. Use tax-advantaged accounts like Roth IRAs or 401(k)s whenever possible. They can shield your gains from taxes entirely or delay them until retirement. If you must sell, try to hold for over a year to qualify for long-term capital gains. And don't be afraid to get professional advice. Just make sure your advisor is fee-only and not commission-based, so their interests are aligned with yours. Fees and taxes might seem like boring details, but they matter a lot. Master them, and you'll keep more of what you earn, grow your wealth faster, and stay one step ahead of the average investor who's bleeding money without even realizing it. Mistake number 7 is emotional investing, letting your feelings dictate your financial decisions. It sounds obvious, even avoidable, but in reality, it's something nearly every investor struggles with at some point. Why? Because money isn't just numbers on a screen. It's tied to your future, your security, your dreams, and that makes it emotional. When a market dips, fear kicks in. When it soars, greed takes over. These aren't just abstract concepts. They're instincts, and if you don't learn to control them, they'll control your portfolio. Think about the last time a market had a major drop. Social media lights up with panic. News outlets predict financial collapse. Everyone, starts talking about pulling out. That wave of fear is contagious, and suddenly, your long-term investment plan feels irrelevant compared to your short-term anxiety. So you sell. You cut your losses. But then the market rebounds, as it often does, and now you've locked in a loss instead of riding the wave back up. That's emotional investing. And it's not just about fear. Greed plays its part too. When people see a stock going up fast, they rush in, afraid of missing out. It doesn't matter if they know the company or believe in the business. They just don't want to be left behind. This fear of missing out, or FOMO, is just as dangerous as panic selling. It leads to buying high, chasing trends, and getting caught in bubbles that are bound to burst. And when those bubbles pop, the same emotion that made you buy greed turns into fear, and the cycle repeats. The most successful investors don't eliminate emotion. They manage it. They build systems that help them stay disciplined. They set rules for when to buy and sell, automate their contributions, and stick to a strategy even when their instincts scream otherwise. They understand that the market is a roller coaster, and if you try to jump off in the middle of the ride, you're going to get hurt. So if you find yourself making decisions based on headlines, hype, or gut feelings, pause. Zoom out. Ask yourself, is this part of my plan, or am I reacting emotionally? Because in investing, your mindset matters just as much as your money. Control your emotions, or they'll control your financial future. Mistake number 8 is flying blind, investing without a real strategy. It's surprisingly common. So many people jump into investing because they know they should, but they don't take the time to ask themselves why they're investing in the first place. They download a brokerage app, watch a few trending videos by whatever's popular, and hope it works out. There's no long-term plan, no clear goals, no structure, just random decisions stacked on top of each other. And while that might feel like progress in the short term, it often leads to confusion, regret, and missed opportunities down the line. Investing without a strategy is like getting into a car and just driving without a destination. You might get somewhere, but it's probably not where you wanted to go. A solid strategy acts like your GPS. It keeps you focused. It helps you navigate through market turbulence. And it gives you a framework for making decisions that align with your goals instead of your emotions. So what does a real investment strategy look like? It starts with clarity. What are you investing for? Retirement? A home? Financial independence? Your child's education? Once you define your goals, you can work backwards to figure out how much you need, by when, and what level of risk you're comfortable taking. From there, you build a portfolio that matches those needs. It might include index funds, bonds, real estate, or a mix of asset classes depending on your timeline and risk tolerance. A strategy also means setting rules, like how often you'll contribute, when you'll rebalance, and under what conditions you might sell. This helps you avoid impulsive decisions and stay on track even when the market gets volatile. And yes, your strategy can evolve over time as your life and goals change. But the key is having one to begin with. Too many people treat investing like a game of luck when it should be a long-term plan rooted in logic. The markets don't reward random moves. They reward discipline, patience, and strategy. Without a plan, you're just reacting. With a plan, you're building. So take the time to create a roadmap for your investments. It doesn't have to be perfect. It just has to be intentional. Mistake number 9 is one of the most dangerous traps in modern investing: following the crowd. It feels safe, right? If everyone else is doing it, it must be a good idea. When you see headlines raving about a hot stock or your social feed full of people bragging about their gains, it's incredibly tempting to jump in. After all, nobody wants to be the one who missed out. But here's the hard truth: the crowd is often wrong. And by the time most people start piling in, the real opportunity has already passed. This kind of herd mentality leads to buying at inflated prices, often right before the bubble bursts. You saw it with meme stocks. You saw it with crypto booms. You see it every time there's a market frenzy. What's presented as a movement or a once-in-a-lifetime opportunity often turns out to be a classic pump and dump. Early adopters make the money. Latecomers, the ones swept up by the hype, are left holding the bag. The problem with following the crowd is that it puts your financial decisions in the hands of people who don't know your goals, your risk tolerance, or your financial situation. They're making decisions based on emotion, hype, or blind trust in someone they've never met online. And when things go south, they disappear, but you're stuck with the losses. That's the danger of outsourcing your thinking to the masses. Now, that doesn't mean you should ignore trends or avoid popular investments altogether. It means you need to stop and ask, does this make sense for me? Have I done my research? Do I understand the risks? If this trend ended tomorrow, would I still be okay with this decision? Independent thinking is a superpower in investing. The best investors in history didn't build wealth by copying the crowd. They often succeeded by doing the opposite. So the next time you feel that urge to jump into something just because everyone else is doing it, pause. Zoom out. Remember your plan, your goals, and your strategy. Trend come and go. Social media noise fades. But your financial future is too important to be driven by FOMO. Be informed, not influenced. Be intentional, not impulsive. That's how you stand out from the crowd and stay ahead of it. Mistake number 10 is perhaps the most heartbreaking of all: giving up too soon. It's the silent killer of wealth building, because most people don't fail due to lack of knowledge or bad luck. They fail because they quit. They start investing, hit a rough patch, get scared, feel like it's not working fast enough, and walk away. They sell everything. They close their accounts. They tell themselves, investing just isn't for me. And just like that, they stop the process that could have changed their life, all because they didn't stick with it long enough to see results. The truth is, wealth is rarely built in a straight line. The market goes up, down, sideways, sometimes all in the same week. You'll have great months and scary months. You'll question yourself, your strategy, and your patience. But here's the thing: every successful long-term investor has gone through those same emotional lows. The difference? They didn't give up. They understood that market volatility isn't a reason to quit. It's a natural part of the journey. There's a powerful concept in investing called staying the course. It means committing to your plan even when it's uncomfortable. It means trusting the math of compound growth, even when it feels like nothing's happening. Because for the first few years, it might not feel like much is changing. But that's how compound interest works. Slow at first, then explosive. If you quit before that curve starts to rise, you miss out on the part where your money really starts working for you. Many people underestimate just how much time matters in investing. The longer you stay invested, the less impact short-term volatility has. Over decades, those bad weeks and red months become tiny blips on a much larger upward trend. But if you let temporary setbacks scare you away, you'll never see that growth. Giving up too soon doesn't just cost you money. It costs you the chance to experience financial freedom. So if you're feeling discouraged, remember this. Success in investing doesn't come from being perfect. It comes from being persistent. You don't need to time the market. You don't need to pick the next Tesla. You just need to stay consistent, stay focused, and most of all, stay in. The biggest wins go to those who keep going. So there you have it. The 10 worst investing mistakes that quietly sabotage your wealth. They don't always look dramatic. Most of them feel normal, common, even logical. But over time, these small missteps, chasing quick gains, investing blindly, try time the market, starting too late, putting all your money in one place, ignoring fees and taxes, letting emotions take over, having no strategy following the crowd, and giving up too soon can add up to one major outcome. Staying broke. Not because you didn't have the money, not because you weren't smart, but because you didn't have the right mindset and approach. But here's the empowering part. Every single one of these mistakes is avoidable. That means no matter where you are in your journey, whether you're just thinking about investing or already knee-deep in it, you can course correct today. You can build a plan, learn from what didn't work, take control of your future. That's the beauty of investing. It rewards those who are willing to learn, adapt, and stick with it. And don't think for a second that you need to be a financial expert to succeed. Some of the wealthiest investors keep it incredibly simple. Steady contributions, diversified portfolios, and long-term patience. It's not about getting rich overnight. It's about building something that lasts. Something that works for you in the background while you live your life. That kind of wealth, it's available to you, but only if you stop making the mistakes that pull you off course. So take this video as your wake-up call and your roadmap. Go back through the list. Be honest with yourself. Which of these mistakes are you making right now? What's one change you can make today that your future self will thank you for? Because the people who build wealth aren't the ones who never mess up. They're the ones who recognize the pattern, make the adjustment, and stay in the game. If this video helped you gain clarity or gave you a new perspective, hit that like button. It really helps the channel grow and reach more people. And if you want to keep learning how to build real, lasting wealth without the fluff, make sure to subscribe and turn on notifications. You've got this. Now go invest like it.